Today, I will be sharing a strategy for trading one of the best known and most commonly used indicators in technical analysis. It's a MACD indicator. It's a convergence and moving average indicator. You can see it at the bottom of the screen. This indicator is based on the classic trading strategy on the crossing of two moving averages. One is faster, the other slower. And when we see a crossing between these moving averages, we use that as a signal to enter the trade. Today, I will be talking about why MACD is a more accurate indicator than the usual strategy with averages, what MACD consists of, how it counts prices, and in combination with what technical analysis tools, it is better to use it for profit. So the MACD indicator consists of 4 elements. The first 2 elements are 2 moving averages. One is the faster one, in this case marked in white color. It is a moving average with a period of 12. That is, this curve shows the price change over the last 12 candles. It reacts more quickly to price movement on the chart. For example, here the chart rose, and this was instantly reflected in the moving average. Same here. When the chart went down, the white moving average quickly went down as well. This line is what is called the MACD. The second moving average, orange in color, is called the signal line. It is slower and counts the average price for 26 candles instead of 12. That is, it will be slower to respond to chart changes. For example, here, as in the previous example, the chart has grown and the signal line reacted a little later. It is the interaction of these 2 lines that is important for us to pay attention to. We also have a histogram on the screen, which are bars that show the difference between the moving averages. They can be red and green in color. The red color indicates that the MACD line is lower than the signal line, and the main signal of the strategy is the crossing between 2 moving averages. That is, for example, here the MACD line crossed the signal line from bottom to top, which means a buy signal. We see a buy signal after the crossing, which successfully worked out. The bars show the difference between these lines. Red color means that the MACD line is significantly lower than the signal line, and the green color means that the MACD line is higher than the signal line. When the color changes, it means that an intersection has already occurred. Moreover, we can see by the color and size of these columns how strong the movement is, how much distance between our main lines. For example, if we see our signal, in this case a crossing from bottom to top, it is a signal for an uptrade. And we can see that the columns are only getting bigger over time. We see the same thing on the chart, that there is a strong movement. So if the columns are high, it indicates that the trend is strong and it is still there for now. We can use it. Same with the red bars. For example, here we see a sell signal. The MACD line has crossed the signal line. And here, according to the strategy, we should open a trade. Here too, the signal worked out, though not so quickly. And as you can see, because the fall, unlike the rise, is not as strong. The MACD bars are also small. They show that a downward crossing has occurred. We got a down signal, but it is also weaker than the previous one. And as you can see, the bars can be green and light green, red and light red. When the bars change from bright to pale, it means the signal is starting to fade. That is, the specific signal, our moment to enter, for example up, begins to fade. So let's go over again how the lines interact and how the bars of the histogram interact. The main signal for us is the crossing of the 2 moving averages. As soon as the moving MACD crosses the signal MACD, it is a buy signal for us. This is where we should have gone into a buy deal. Next, we see a trend developing. We can still use this signal. And as soon as the color changes to pale, we can see that the signal starts to fade. This is where we should close the trade. Then we are in the market. And after that, we have a second signal, which is the opposite. Now the MACD line crosses the signal line from bottom to top. This is already a signal for a down trade. Here we should have entered the trade down, and as soon as the color changes from bright to pale, we realize that the trend is starting to fade, and somewhere here, we should lock in a profit. That is, we wait for a MACD crossing and see by the bars how strong this trend is, and when we need to exit the trade. And the fourth element of the MACD is the zero line. The zero line is an indicator of a long-term trend. If both lines are above zero, it means that the long-term trend is upward, and vice versa. In such situations, it is better to choose only up trades and ignore down trades, as in our case. We have a good deal up and a relatively good deal down. If both slides were under the zero line, then we were more likely to need to look for down trades. Setting the MACD indicator is very simple. We need to go to the indicators menu. At the top of the screen, type MACD and set it on the chart. It is set by default with the settings we need, 12 and 26. Why we should use MACD and not the classic moving average strategy. Here I have plotted both the MACD and two moving averages with the same periods. Why exactly will the MACD work better? That's because a more complex formula with a slight shift is used here, and it evaluates the move a little earlier than regular moving averages. If we take the classic strategy, where the fast moving average crosses the slow one from bottom to top, we should have entered the trade right here. But as you can see, the MACD gave us a signal on the chart a little earlier, and we would have entered the trade here. Specifically, in this example, there's a slight difference between the entry points. But as you can see, we would have gotten a better result and would have caught this trend movement earlier with the help of MACD. In this example, the classic strategy gives us a signal at this point to trade down, but MACD gives a signal at a different point, and we would enter the trade here, and that would give us a much bigger profit. As you can see, MACD is a more operational indicator, and it finds medium and long-term trends a little earlier. And this solves one of the biggest problems with the classic strategy, that it lags a bit behind the present trend. Therefore, MACD is a quicker, faster, and more accurate way to find these types of entry points. What should we use to increase its effectiveness? So I personally advise beginners to add one exponential moving average to the chart. We go to the indicator section, type EMA, and add the indicator to the chart. But we need it not with a period of 10, but with a period of 100. This means that the exponential moving average now shows the movement not in 10 candles, but in 100 candles. This strategy will work well on any time frame. It does not matter whether one candle shows trades for a minute or an hour, the exponential moving average with a period of 100 will show the result for 100 candles, and specifically at the time in which we work. That is, we will see the big picture. So, by exponential moving average, you cannot zoom in on the chart, not flip it backwards, but just see the current state of the trend. If the chart is below the exponential moving average, it means that the general trend is downward, and you should rather choose trades downward. That is, if MACD gives a signal for an up trade, it should be skipped, and the signal for a down trade should be used to get a good profit. Same thing in this example. When the chart is above the exponential moving average, this means that the medium-term trend is upward, and it is necessary to choose mainly buy trades, ignoring sell signals. For example, if MACD here gave a signal to enter a trade, we would use it, as we understand that the long-term trend is upward, and this is the sell trade we would skip, because we realize it is not in line with the trend, and this trade could be a danger signal. There's also a more advanced way to use MACD for more professional traders. You can read the indicator together with elements of classical chart analysis. For example, we can combine signals with support and resistance levels. So if we see that we have a level of support in this area, also in this area we have a level of support. If MACD and these levels coincide, it will be an additional confirmation of the signal. For example, here we see a trend chart, and we can map the boundaries of the trend channel. In this case, if the signals on the new channel will coincide with the MACD indicators, it will be an additional reason to open a deal. For example, here we see that the chart has touched the upper trend boundary, and we see the signal on the MACD. So this is a great signal to enter a trade down. In the same way, you can use other indicators and other elements in trading. For example, you can use candle patterns. We have a match at this point. This figure is called an engulfing pattern, when after a long-term trend, there is a candle in the opposite direction that engulfs the previous one. This is a strong signal, and in our case, it also coincided with the MACD indicator. That is, if we use candlestick patterns or additional price action lines, we can additionally confirm signals by MACD. This is such an interesting indicator, which can be used in different combinations in different strategies, and be sure to try it in your trading and share your feedback in the comments. See you soon.